Morning, financial mathematics students. Today we're going to be going over the Unit 10 activity. It has to do with payroll and income tax, but it also has to do with other taxes in general. So we're going to go over sales tax. We're going to go over capital gains tax. But if you're here, join me on page 5 on this activity, and you should see this information here. So payroll and income tax is the first part. And you can see this information about this person here, Daniel Garcia. You can see a couple of the important pieces of information you're going to need to look at is the fact that he's single with no dependents. That's key. And then also his annual salary. Those are important parts to determine how much income tax he's going to have to pay. So let's go ahead and look at this form that he filled out. So when you get hired for a new job, you're going to have to fill out a form or a worksheet like this. And it helps you fill out your W-4 form. So this first worksheet, though, has to do with how many allowances you get. The number of allowances, the more allowances you have, then the less taxes you have to pay. In the case of Daniel, you always enter 1 for yourself. So in line A, this will always be a 1. And he also entered a 1 for line D. So notice it's because he's single and he only has 1 job. So he put a 1 there. Notice he didn't put a 1 for lines B or C because, well, he's not married. Remember, Daniel is single, if you recall. So he doesn't put a 1 there. Okay. And so as he's filling out this worksheet, he's put a 1 here, a 1 here. And then in line H, you would add the total you would get from A through G. And that would give you whatever you put in line H. So line H basically is your total allowances. Now, in the case of Daniel, he should have 2 allowances. So he's filling out his W-4 form, and he's filling it out on January 8th, 2018. So let's go and review his work. And there's a mistake here in one of these red boxes. Let's go and see if we can find the mistake. So single, no, that's correct. Remember, Daniel is single. His social security number, he did that correctly. It matches the social security number up here. So that's good. And the date, 1/8/18, yeah, that's correct. He's filling this out on January 8th, 2018. So the problem here is right here. This is the number of allowances. So this number comes from, again, the worksheet above. Line H is what number can go here, okay? So that's the mistake he made for filling out his W-4. Let's go ahead and move on to question 2. And this one has to do with how much taxes he's going to pay on a weekly basis. You can see Daniel's gross weekly pay is $882.96. So that's the gross pay, but that doesn't mean that's how much is on the check that he gets. How much is on the check would be his net pay. Now, to figure out his net pay, we're going to have to deduct taxes and any other things from, but mostly taxes. So his weekly gross pay is $882.96. When he gets his first paycheck, Daniel notices that payroll taxes have already been deducted from his pay. Payroll taxes include Social Security tax and Medicare tax. Use the table to complete the statement. So select the correct answer from the drop-down menu. So you can see here that for Social Security tax, he's paying 6.2% for that portion of the payroll tax. Also, the Medicare tax is 1.45%. So his total payroll tax, you just add those together. So 6.2% plus 1.45% gives you the 7.65% in total payroll tax. So let's go and see if we can answer this question down here. Based on the payroll tax table above, in every weekly paycheck, Daniel will pay a certain amount in Social Security tax and a certain amount in Medicare tax. So all we need to do is find 6.2% of his gross pay, and that'll tell you how much he pays in Social Security tax. Then find 1.45% of $882.96, and that'll give you his Medicare tax. So how do we do that? Well, to find a percentage of a number, it's actually pretty simple. What you do is you change that percentage to a decimal. Now, notice these percentages already have a decimal in them. So what we're going to do is move the decimal over 2 places. So as a pure decimal, that's 0.062. To change this one to a pure decimal, again, move the decimal 2 places, 0.0145. And you're going to multiply each of these times his gross pay, which is $882.96. Multiply those together to get his Social Security tax, and multiply his gross pay times the Medicare tax rate. And that'll give you how much he pays in the Medicare tax. Okay, so that's how we're going to answer these two questions. So just multiply that together to get the first drop-down menu, multiply these together to get the next drop-down menu. Okay, so you should be able to do those. Okay, part B. Recall the United States has progressive income tax system, and the marginal tax rate increases as the income of the taxpayer increases. The tax rates and brackets for single individuals in 2018 are shown in the table. And honestly, these numbers haven't changed much since 2018. I'm not even sure if they changed at all. So this is probably something similar, but you should always check depending, tax brackets change according to new laws that get passed and so forth. But you can see here for your first, if you earn zero between $0 and $9,525, you pay a 10% tax rate. For this second bracket, between $9,525 and $38,700, you'd pay 12% tax rate. So you can see as you earn more money, you end up in a higher and higher tax bracket. Okay. So let's go ahead and look at question 1 here. Using the single income tax brackets for 2018, select the appropriate marginal tax rate for each individual, select the correct rates in the table. So let's look at this first one is a teacher with taxable income, $40,259. That's a pretty sad amount of money for teachers. So which tax bracket are they going to end up in? So it looks like they're in this tax bracket here. So 22%. Okay. Now I want you to keep in mind that doesn't mean that all of their money is taxed at 22%. That's not what that means. Most of their money will be taxed. Some money will be taxed at 10%, right? The first $9,525 gets taxed at 10%. Then the money earned that's more than $9,525, but less than $38,700. So in the money that falls in this group gets taxed at 10%. And then between $38,700 and $82,500 gets taxed at 22%. So it's kind of interesting like that, but yeah, so this teacher's tax bracket is 22%, but again, that doesn't mean that all of their money is taxed at that rate. Well, only the money that's above $38,700. Okay, pediatrician, taxable income, $194,680. So what tax bracket does that put them in? Well, that puts them in this tax bracket. So 32% tax bracket. Okay. See if you can answer these other two, figure out which tax bracket is the highest tax bracket for each of these individuals. Okay. Again, just figure out which gap they fall into. Okay. Let's go and look back at what Daniel had. Remember, Daniel says, assume that Daniel's taxable income after taking the standard deduction is $33,914. So this is his taxable income. Which equations will Daniel need to use to calculate the amount of income tax on his taxable income, where X is the amount of taxable income that's taxed at the corresponding marginal tax rate, and Y is the amount of taxes on? Okay, a lot of them using the word tax over and over again, or taxation or taxable. But if this is his taxable income, let's go and look at that chart up here. And which tax bracket does he fall into? Well, he falls into this 12% tax bracket, right? So which equations is he going to need to use? Well, some of his money gets taxed at 10%, and some of his money gets taxed at 12%. Okay, we're going to go over the specifics of how this is done, but the first $9,525 gets taxed at 10%, and then above that gets taxed at 12%. Okay. And that's the highest bracket he goes up to. So in Daniel's case, he's going to need this 10% tax, which is equation 1. And he's going to need this 12% tax rate, which is equation 2. So he's going to need equations 1 and 2. That's it. Okay. Select the correct answer from the drop-down menu. So recall Daniel's taxable income, $33,914. According to the single taxable income tax bracket for 2018, the amount of income tax that Daniel owes is, so here's where we're going to basically use those equations we saw from up here. Okay, the 10% and the 12%. So let's go back up to this table here, and we're going to need this table. We're actually only going to need these 2 lines of the table. Okay, so according to this, let me not highlight that. Okay, according to this, his first $9,525 gets taxed at a rate of 10%. So we're going to multiply by 0.10. Okay, again, change the percent to a decimal by moving the percentage over twice. Okay, let's figure out how much that is. So I got my calculator here, and I'm going to multiply that together. 9,525 times 0.1. So that's $952.50. Okay. Now that's for the first $9,525 that he earned, but he earned more than that, didn't he? Right? He earned $33,914. So what you're going to do is you take the $33,914, his total taxable income, and you subtract out the amount that was taxed at 10%. So I'm going to take the $33,914 minus this 9,525. Okay, that leaves him with $24,389 of taxable income. But this income is in the second tax bracket, right? Because it's above, it's how much he earned that's above 9,525, sorry. And so that gets multiplied at a 12% tax rate. Okay, so I'm going to multiply by 0.12 times that. That gives us that the money that has to be paid here is $2,926.68. Okay, so the total amount that he has to pay in taxes for the year, we're just going to add those together. So you add how much fell into this bracket plus how much fell into this bracket plus 952.5. So the total taxes he owes is $3,879.18. Okay. All right. Hope that made sense. Let's go ahead and we want to answer that. What was it? This one, right? I think I did that right. Good. Okay. Question 4. The purpose of filling out the W-4 is to make it easier for individuals to meet their tax liability by paying income taxes as they earn income. So you notice if you have a paycheck, you'll notice that they take out taxes from it. The reason why is because if you pay taxes throughout the year, then ideally at the end of the year, when you have to pay your income tax or whatever, hopefully you don't have to owe any more than you've already paid, right? If you didn't pay enough throughout the year, then you're going to owe taxes when the tax season comes along at the beginning of the following year. So paying anticipated taxes from each paycheck reduces the amount of individual owes when filing taxes and can even result in a tax refund. You know, a lot of people, they get a tax refund because they paid more in taxes than they actually needed to throughout the year. To guarantee or increase the refund, individuals sometimes claim fewer allowances to have more income tax withheld or request a specific additional amount to be withheld from each paycheck. Daniel's employer will automatically deduct taxes from Daniel's pay using the information on the W-4 from Daniel completed on his first day. From the W-4 form, Daniel's employer determined that $75 needs to be withheld from each of Daniel's paychecks, totaling $3,900 for the year. Compare Daniel's tax liability from Part B, question 3, with the total amount withheld from his paycheck or from all his checks, which is $3,900 for the year. If Daniel wants a refund, when he files his taxes, should he have filed his W-4 differently? Explain your reasoning. Okay, so throughout the year, he's going to end up paying $3,900 in taxes. So that's each paycheck takes a little bit of money out. His employer decided, okay, $75 gets taken out every paycheck for taxes. So that's a total of $3,900 in taxes. But how much does he actually owe? Well, we determined that right here, right? $3,879.18. So you can see he owes just this amount, but throughout the year, he's paying a little bit more, isn't he? Right. So since throughout the year, he's paying more than he actually owes in taxes, at the end of the year, he's going to get a tax refund. So according to how he filled out his W-4 and $75 getting taken out of his paycheck every week, he's going to end up getting a tax refund at the end of the year. So the amount of the tax refund, you take however much you paid minus however much you actually owe in taxes, and that'll give you a refund. So his refund's not going to be very much at all. So his refund in this case is going to be $20.82. Again, it's just subtracting these. So I want you to explain that according to this information, that Daniel is going to get a tax refund, in this case, $20.82, because he ends up paying more in taxes throughout the year than he actually owes. Okay. All right. So I explained it. Hopefully that made sense, and hopefully you could explain it right here in your own words. Okay. All right, let's go ahead and move on to the next page, page 6. And let's go ahead and do this. So this talks about sales tax. So depending on where you live, sales tax can have a significant impact on your purchase decisions. While the few cents added to a pack of gum might not hurt your wallet, the taxes on larger purchases might have a greater impact. Learn more about state and local sales tax, including viewing a map that compares sales tax rates across the United States. So if you click on this link, you're going to be taken right here. This basically gives you the sales tax rate for various states across the US. Okay, so you can see California, 8.54%, which is the 9th highest. Some states are more. Louisiana is the highest with 10.02% tax rate. This is in 2018, so these numbers are probably a little bit different now in reality. Some states don't pay any sales tax. So that's Oregon, Montana, New Hampshire, and Delaware. They don't pay any sales tax. And I think Alaska now doesn't pay any sales tax either. Again, these numbers have been changed since this was published. So, but this is basically your sales tax rate. So this is like, you buy something from the store and there's always some sales tax, which is, a percentage of whatever the selling price of the item was. Okay. Now, it might not mean much for some things, but if you buy a car, cars are expensive. So the sales tax adds up really fast. We're going to go over that here. So let's take a look at Part A. A state sales tax of 6% and a local tax of 1% are levied in Tampa, Florida. Suppose the price of a particular car in Tampa is $15,000 and an oil change at a certain auto center is $29. Which statement is true about the total cost of the car and oil change after sales tax has been calculated? Select the best answer. So let's go ahead and I'm going to grab this information here. And if you take a look, let's just add these taxes together. So that's going to be a 6% state sales tax and a 1% local sales tax. So in total, that's a 7% sales tax in Tampa, Florida. If I want that as a decimal, which I do, it's going to be 0.07. And we're going to multiply as 0.07 times however much you spent on the car. So that's $15,000 times 0.07, which is 7%. And this will tell you how much sales tax on the car. So 15,000 times 0.07 gives us $1,050. So this is the sales tax on the car, right? So you can see sales tax adds up pretty quick when you're dealing with a car or other expensive things. So the total amount he's actually paying would be the $15,000 plus the sales tax of $1,050. So that's $16,050. So the car actually costs, this is how much you're gonna have to pay for the car. Same idea for the oil change, but in our case, that's only $29. So $29 times 7%. This is not gonna be very much. So let's figure out how much sales tax for the oil change. 29 times 0.07, $2.03. 2.03. We're going to add that to the normal price of the gross price, right? So this would be $31.03. So this is for the oil change. This is for the car. Okay. Part B, select the correct answer from each drop-down menu. Celeste is planning to buy a new bedroom set. Because the sales tax rate can vary from town to town, Celeste wants to compare the sales tax rate of 2 retail locations before making the purchase. The price for the new bedroom set Celeste wants to buy is $2,734. The sales tax rate in two cities at the time of purchase are given in the table. So Valdosta has a state tax of 4%, local tax of 3%, so a total tax of 7%. Total sales tax 7%. In Tallahassee, Florida, 6% state tax, 1.5% local tax, so 7.5% total sales tax. So you can see which one's going to be cheaper. Well, this town in Georgia is going to be cheaper because it's 7%. Here it's 7.5%. So this one's going to be cheaper sales tax. So how much will she save? So let's figure out how much tax she would pay in each of these situations. So let's go ahead and do for this Valdosta, it's going to be $2,734 times 7%. So that's 0.07. For this, it's the same. For Tallahassee, it's the same selling price, but this time Celeste would have to pay 7.5%, so it's 0.075. Okay, so how much sales tax would be here and how much sales tax will be here? So let's go ahead and multiply that together. 7. So here, the amount of tax would be $191.45. Here, the tax would be $205.13, rounds to the nearest cent. So how much money she save? How much money will she save if she goes with this decision? So you would subtract these. So minus 191.45. So she would save $13.68. Well, they didn't round correctly, but that's okay. So she would purchase it. What city should she purchase it in? Put that here. Which city is cheaper? And then which one was more expensive? You should know that if you were listening. Okay, let's go ahead and move to the next page when you're done with that. Okay. All right, so we're almost done. Now we're going to talk about capital gains tax, which have to do with selling basically assets that you have invested in earlier. So if you buy an asset, then later on you sell that asset, then the difference that, or whatever money you made by selling that asset, you have to pay a capital gains tax on whatever income you made from that. So let's go ahead and take a look. I'm going to read this here. When you make money, whether from a salary or from profit on investments, you owe taxes to the government. Recall that capital gains are the profits earned from the sale of assets, while dividends are paid out to shareholders in a company as part of the distribution of a company's profits. Interest income is the interest you earn on investments. One measure used to calculate the performance of an investment is the return on investment, or ROI. Return on investment, ROI, is represented by a percentage or ratio. It can be calculated using this formula. So return on investment equals the net profit from the investment divided by the cost of investment. All right, so we're gonna be calculating this. It's not too complicated, but let's go ahead and look at this information. Let's say that Carlos, an investor, sold some stock that he had held for 3 years, and the stock paid qualified dividends. Use this pre-tax information to complete this task. So we could see his taxable income. He's single. The dividends that were paid out, $10. Capital gains, so $55. $250 is how much the investment cost him. All right. The table gives information about qualified dividends and capital gains tax rate on taxable income of unmarried individuals. So for Carlos, he's got $65,349 of taxable income. So that's going to put him in this middle tax bracket, 15%. So this will be his capital gains tax and tax on qualified dividends. You can see here's his dividends and here's his capital gains. So that's a total of $65, and he's going to get a tax rate of 15%. Okay. Now let's take a look. Considering Carlos' dividends and capital gains, which statement is true? Select the correct answer. So he earned $10 again from dividends plus $55 in capital gains. So how much did he get? Well, that would be $65. Now we also want to figure out his ROI, his return on investment. So what you're going to do is his return on investment, you're going to have to take the net profit from the investment, which in our case was $65. So you include the dividends and his capital gains, and you divide by the cost of the investment. So that's $250. Okay. This will give you a decimal, and we want to change that to a percentage. So this gives us 0.26, which is 26%. So his return on investment is 26% return on investment. Okay. All right. Determine the nature of Carlos's investments and identify the tax rate for his capital gains and qualified dividends. So first we need to determine, was his investment short-term or long-term? Well, if he's held the investment for at least a year, so a year or more, then that's a long-term investment. And you can see in the case of Carlos, we read this, he held it for 3 years. So he held the investment for 3 years, which means that this is a long-term investment. So any length of time that's a year or more, that's a long-term investment. And as we already determined, his capital gains and dividend tax rate will be 15%, right? Because he falls into this tax bracket for because of his taxable income, he falls into this tax bracket, which is a 15% tax bracket for capital gains and qualified dividends, as long as for long-term investments. Okay. So select the correct answer. Okay. Recall that tax owed will reduce Carlos's net profit. So Carlos's real after-tax return on investment is, so first let's figure out how much tax is he going to pay. He's going to pay 15%. So what we're going to do is we're going to first do we're going to do 15% of the income that he got, right? So 15% times the gains times times 65. So he's going to have to pay $9.75 in tax. So the amount of money he actually got, so he originally got 65, but he has to subtract off his tax. $65 minus 9.75, $55.25. So that's what he's bringing home from his investment. Now, let's figure out his return on investment. So again, his return on investment, you take your income divided by the cost of the investment. If you recall, that was $250 was the cost of investment. Go ahead and divide that, and that'll give you his ROI. So it's one of these, okay? So again, divide this, and that'll give you his ROI. Okay. Hope that makes sense. Go ahead and finish that. And I hope you're able to do all that. Well, with that, that's the end of the lesson. If you would like to thank me, then just subscribe. Or you could share this video or my channel with anyone you feel that might benefit from it, such as your teacher or another classmate of yours. All right, well, with that, thanks for watching, and I'll see you guys next time.